Hi there, and thank you for joining us for a quick update of the Purpose Tactical Asset Allocation Fund and ETF. My name is Craig Bassinger, and I'm the lead portfolio manager for this fund for Purpose. And in this quick presentation, we're just going to provide a little bit of background on the tactical strategy and then touch on how it's done during the recent period of more volatile markets, both down and up. But first, let's take a quick peek at our disclaimers. And then let's get into it. So why be tactical? There's really two approaches to asset allocation. One is the more common, which is to take a static approach, meaning that you determine your asset allocation based on your long-term objectives for a client, and then you sort of set that allocation and maintain that through good times and bad. Well, being tactical is really taking that baseline allocation and then tilting it in one direction or the other to have more market exposure or less during different periods of the market cycle. There's no question the static approach is probably easier to implement, but it does have a downside. Markets have become more volatile with bigger swings. And if it is a static asset allocation, perhaps 60% equity, 40% bonds or alternatives, then you remain 60% exposed in both good times and in bad. Well, being tactical, what you're attempting to do is during those good times to tilt more towards equity or more market exposure, and during the bad times to have less market exposure. I mean, sounds pretty good, but clearly it's not easy to implement. And the fact is, if you look at the economy, monetary policies, pandemics, you can come up with opinions on these, valuations, the yield environment, credit spreads. It's one thing to try and get all of these factors correct and what's going to happen going forward. And then it's another thing to also see how the market reacts. A great example is today. The market is now $28 trillion globally. This is the equity market, $28 trillion higher than it was before the pandemic even started. And this is with, parts unemployment still high and still emerging from this pandemic. Few would have thought markets would have recovered this strongly and this much and made new highs to this degree. And there's no question markets have evolved, and markets always evolve over time. And I think one of the key aspects that's been going on is they have become faster and with bigger swings, which we believe lends to having a tactical component to a portfolio. And the other reason to consider being a little bit more tactical is defense has become harder to find. There's no question bond yields are extremely low. We've been in sort of a multi-decade period of falling yields. And while they may be starting to rise now going forward, they are still very low, which means that the bond allocation in a portfolio really has a lower return expectation or income. Add to this, credit spreads are very low. People have put more and more exposure onto the credit side away from government bonds to sort of help the cash flow. But this has reduced the defensive characteristics of the bond portion of many clients' portfolios. And of course, the alternatives have really gained in popularity, and we're firm believers that people should incorporate alternatives into their strategy. But it's also a bit hit and miss because some have done well, some have done poorly at different points in time. And it really requires a lot more due diligence on selecting managers and selecting strategies and how they fit into a portfolio. So the end point here is that becoming defensive and having a defensive component of a portfolio has just become more challenging. So what is our solution for being tactical within a portfolio? When we set out to create the strategy back in 2011, the goal was pretty straightforward. We wanted to have more market exposure in good times and less market exposure in bad times, whether it's a bear market or a correction. We also wanted to use a systematic rules-based approach. And we also wanted to have a meaningful impact. In other words, to be very tactical within our strategy so that you can have a meaningful impact on an overall portfolio with a reasonably small allocation. So our strategy, it is rules-based, which avoids human emotion and what our view of where we think the market's going. It is rules-based, so that sort of alleviates some of that pressure. And the strategy itself can actually oscillate as much as 100% equity and no bonds, all the way to no equity and 100% bonds. And we use plain vanilla ETFs to implement this strategy. And tactical is really designed to reduce risk uh, during periods of market stress and increase market or equity exposure during better times. And we do this, again, as I mentioned, using plain vanilla ETFs, and we primarily only use North American ETFs as well. We have about 55% of the strategy is in Canada, between Canadian bonds and Canadian equity, and a mix between the two, and 35% on the US side, with a little bit of discretion that handles cash and other components. So that's how strategy effectively work, how tactical effectively works. But how is it done during this the recent bouts of volatility? And we have had quite a few sort of corrections in bear markets over the last couple of years. So I think it's a prime example. And this is our tactical strategy. We just plotted it here against the TSX. And in the bottom portion of this chart is the equity weight over time. And as you can see, well, we don't quite get to zero and we don't quite get to 100%. We get pretty close. And the asset mix within this strategy, within this fund and ETF moves quite a bit. So if we just zoom in a little bit to 2018, this was a correction back in late 2018. And as you can see, our equity weight started off relatively high, but when the market started to lose momentum, we started to de-risk and move more out of equity and more into bonds. And that really helped preserve our asset value and the price of our fund during this period of market turmoil. But that's one component. The other is catching the other side, because markets do recover. And our strategy, well, doesn't start buying at the market bottom. It does very often start buying shortly into recoveries. And as you can see here, we ramped up our equity exposure at the end of 2018 and into early 2019 and really caught a lot of the market recovery and provided, as you can see, a stabilizer for a portfolio during this period of market stress. So let's fast forward to the big bear that everybody likes to talk about because it's the more recent one, and that's in the pandemic-induced bear market. And this was a very fast bear market. It was the fastest bear market in the history of the S&P 500 and also the TSX, and obviously recovered quite quickly as well. And again, in developing these kind of strategies, it's really crucial that you keep them relatively simple and relatively straightforward because like I've often found, the more complex you make things, the more chances are that they will break and not do what they're supposed to do. Our strategies are relatively straightforward. As the market started to, roll over and decline, we quickly started to reduce equity and move more into bonds and cash. And as you can see, that helped shield our asset value during this period of market turmoil. And coincidentally, after the market bottomed, we quickly started to re-add onto the equity side pretty quickly to enjoy like a reasonable amount of that upmarket bounce. And that's how we navigated the pandemic bear market of 2020. So fast forward to more recent times, obviously the market's been doing very well. And as a point, tactical has actually had a relatively heightened amount of equity exposure during this period. We won't quite keep up with a strong bull market like we're in now, but we'll capture a really decent amount of that upmarket swing. And you complement that with our defensive characteristics during periods of market turmoil, you can clearly see how this strategy can provide a strong stabilizer for a portfolio and provide a rules-based approach to adding a tactical component to your asset mix. So what's next for markets? We have our fundamental views, but I'll be honest, the bulls are out there saying reopening, driving the economy, helping earnings. There's tons of stimulus out there from monetary and fiscal side. The pandemic is starting to fade, but the bears have a pretty strong argument as well. Like I said, we added $28 trillion to global equities from a valuation perspective above where it was before the pandemic hit. So valuations are stretched. And the economic data, while certainly good, is starting to lose a bit of momentum. And again, which one will prove right in the markets? It is difficult to say. We do fundamentally tilt a little bit more on the bullish side right now. But that being said, the market surprises everybody. And one of the strengths of having a rules-based approach is that it takes a lot of that emotion and sort of guesswork out of it. If this market does roll over and start to weaken, based on how we've designed the strategy, we will become defensive very quickly. If it does continue to march on higher, which I think would be the best for everyone, obviously, we will capture a reasonable amount of that upmarket swing. And really, that's what we've designed here. And it's a bit of a different strategy, but it really does complement a portfolio in providing a rules-based tactical component, and give you the peace of mind that during times of stress you'll have a bit less equity because of incorporating tactical into a portfolio, and during good times it'll tilt a bit more towards equity, which is obviously what we want to do when we're being tactical. If you'd like to learn more about this strategy or have any questions, feel free to contact your advisor or any of us at Purpose. We'd be happy to go through in more detail about how the strategy works, how it's done in different market environments, how the back testing and model development work. It's an open book. We're completely open to sharing our approach, and thank you for listening.